I want to talk a bit about macroeconomics. That involves some fixed income as well, and its wide impact. It's very relevant to a lot of news. I mean, today and pretty well all the time. A lot of economies, a lot of major world economies are rather weak at the moment. This implies that central banks want to push interest rates down. So this is expansionary monetary policy. In fact, over the last year, I can't find a single major economy that has a government bond yield that's gone up. And I've looked at sort of US, UK, Japan, Germany, other European countries. Every bond yield is down over recent months. In fact, most of them over recent weeks and days as well. Currently in the US, business confidence is extremely weak. The 10-year US Treasury is just over 1.5% yield. I mean, this is all to do, part of this is to do with tariffs. The US is trying to impose tariffs on EU imports, though the WTO has actually stopped a lot of that. In the UK, we've had interest rates of 0.75% for more than a year now. The 10-year gilt, so the UK's 10-year government bond, is less than 0.5%, just 0.47%. Even our 30-year bond is below 1%. So what's the impact of this extreme monetary policy with interest rates really low? What actually happens? Well, when you've got weak economies, bonds typically do well. And a lot of bonds, they've all gone up in price because of your inverse relationship. You should be familiar with the fact from fixed income that as yields go down, the prices go up. And so if the economy is weak, bonds, ironically, become a very good investment, or at least government bonds do. Corporate bonds, there's a different impact because you may find there's more credit risk as well. So that might offset the benefit of government bond investing. Another impact is currencies fall. If you've got low interest rates, currencies fall. Now, this is notoriously difficult to predict because who can say how much foreign investors are going to be investing capital or withdrawing capital from an economy. But as currencies fall, there's less incentive to put capital into a government's bonds, and therefore quite likely the currency will fall. I'll come back to that idea of having a weaker currency and what the impact of that is. But these days, monetary policy is pretty well dead. Think about the reduction in the UK, hypothetically, from 0.75% to 0.5%. Now, you're reducing interest rates by a third of their value, but it's the same amount as reducing it, let's say, from 9.75% to 9.5%. So in other words, with low rates, you have to be a lot more dramatic to have any impact at all. In the Eurozone, rates have been zero since 2016. So if you ignore the political impact of centralized monetary policy within the Eurozone, what can European governments do to try and boost their economy? The German 10-year Bund, so the 10-year German government bond, is yielding minus 0.6%. You can't do anything with monetary policy there. Fiscal policy could be the answer. Even in the Eurozone, at least governments do have the ability to control their fiscal policy. But if you lower tax rates, that traditionally reduces government income as well. So not necessarily good for the government. Let's just think about, finally, the impact of weak currencies on trade. Governments are actually a little bit ambiguous here. In terms of textbook theory, traditional theory says weak currencies are good for trade, but then the national pride is also dented. If foreigners can see that the currency of a country is very low, I mean, think where the British pound has been over the last 3 years, then it doesn't do the national pride much good. So let's just focus on trade. If you have a weaker currency compared to your trading partners, then on the one hand, exports are cheaper for them. So if they can import goods that you have exported, that's definitely good news. You can export more. On the other hand, with a weak currency, imports are more expensive. And that's potentially bad. Now, you will see in your economics readings at level 1 CFA that there are two ways of reading this, because on the one hand, if you have got the ability to switch inputs for your business, if you've got more expensive imports, you may try and choose a cheaper domestically produced input, which is good for the economy. On the other hand, let's say you're using energy, you're using oil, and oil prices have gone up in your own currency. You just have to keep using this, and therefore, in fact, that can be very damaging to economy. So if you've got a lower currency, if your currency is weaker, it doesn't necessarily mean it's good news for trade. As you read the financial news, you'll realize the importance of really quite a lot of what you're currently studying.